All right, so stock started the week on a high note, kind of continuing the move that we had late Friday going into the weekend. Started off great last night, and then finished the day near the highs of the day. So wasn't as strong of a move today as it was in those last 30 minutes or so, or hour of trading on Friday. But combined, it really helped make up for the big swing, down that we had last week. So good moves. Now the question is, again, as it always is, how much more do we expect? How long will it be? How bullish? Is this the low point? I mean, everybody asks, is this, every time there's an update, everybody asks, is this the low point? It's not like we haven't had updates before during this decline. We had lots of updates during this climb, but it's always, especially on TV, it's the big topic. Is this the low point? We're going to keep going from here, and what's driving it? And so we're going to talk about what's driving the action today to see how risk on it was. And then we'll talk about, what we expect here in the short term, and then what to expect with that continuing intermediate trend that we've been on. And we'll also take a look at a stock that just tanked last week, one of its biggest declines that we've ever seen. We'll talk about how to trade it now going into this week to see how we can take advantage of that big rapid decline while keeping our risk really small. Let's go ahead and get started. Today is Monday, May the 23rd, 2022. This is the Market Outlook for MarketScholars.com. My name is David Settle. All right, let's start off taking a look at the S&P 500 with the market forecast indicator. And look at there, we got a bullish day. The near-term line got into bullish territory. Now, this is not the first time, right? It's gotten into bullish territory these other three times, and each one of these produced a lower near-term low. Now, granted, each one of these came off of a pretty decently bearish near-term low point, right? You had an extended period below the 50th percentile there. You had a pretty deep drop there, and you bounced up very briefly. And then you had pretty much another deep drop that had multiple clusters there. So each one of these peaks came off of, this one came off of kind of a divergent type low point. One cluster instead of three, a higher low point relative to the 30-day moving average down here. So a little bit of divergence, and so not as bearish. So there's a good chance, I don't think necessarily will be this bullish like we saw on that rally, because remember, we got too much resistance above us that we didn't have there. But also I don't think it'll be like a one-day move like we saw pretty much on all of these, right? You had one big update there, you had one big update there, you had kind of 3 days in one there, and then now we'll see how this, it is a close above the high of the low day, if that's something you look at. The intermediate line still in oversold territory, market sentiment still falling in bearish territory. This is hardly a trend changing reversal, but it's a good sign nonetheless. The NASDAQ 100 looks almost exactly the same, though we did not close above the high of the low day there. And then you look at your Russell 2000, and also it did not close, and it did not close above the 23% retracement. See, if you go back to SPX, we're still below the 23% retracement level there, and then NASDAQ, we're well below the 23%. So remember, we don't technically start the pullback, in this case the pullback to the upside, until you break the 23% retracement. That's the key, right? And anytime you're in between those dotted lines, you're in retracement mode, and it doesn't end until you get either back down and we continue the trend, or up above the top one and we reverse the trend to the upside. So you can pretty much tell where we need to get to for us to change this back around to the upside. We need to get above this 14,500 level. So that's what we're seeing right now on the market forecast indicator. If you look at this week's candle so far, it's not nearly as bearish, obviously a much higher low point. We're not closing anywhere near the low, and we are only slightly lower. The PPO is still, the differential obviously still negative. You still have a red candle. PPO is still falling. We don't have a green arrow, so we're not out of the woods, right? We're still pretty bearish in all respects, but to see the NASDAQ, the Russell got the same pattern last week, where we got a higher low point. We did not close below the prior week's low, and it looks like we're doing it again. So we're kind of headed towards transition candles. See, that's what happens when you get those kind of candles. you start heading towards transition. Now we didn't reverse to the upside because we stayed bearish, but that's what, this kind of leads you into transition candles from a weekly basis. Let's take a look at the 3 green arrow charts, and you'll notice that we don't have pink shading on 3 of the 4 indicators. Your diamonds still have the pink shading because you didn't quite get the green arrow on the MACD today that we did on the S&P. We came relatively close. When you look at like the DMI, again, we're still above 30. We're well below 20, so nothing's changed from that perspective. So like I said, hardly a trend-changing rally at all. In fact, I showed this on Twitter. So again, if you follow me on Twitter, it's at DavidSettle42. So make sure you come over here, DavidSettle42. I put quite a bit of stuff here. So one of the things I showed was this chart where the historical volatility is actually really high. In fact, when you look at that level, that is one of the higher levels, right? So if I were to go to, what did we end up getting to, about 30, 35 and a quarter here. So if I were to kind of show this, that's one of the highest levels that we've gotten to. Here, let's try this again. There we go. So let me go out and show 20 years, and then I'll kind of zoom in. So we did get this high, but you notice when we got this high during the COVID, look how high implied volatility was. We were in the 60s or the 50s when we got to this level in historical volatility. We were in the 50s. You come back over here in 2018, historical volatility never got this high. So that kind of gives you an idea. As bearish as we were then, we weren't that bearish as we are now. You look at 15 or early part of 2018, we didn't get close. In 15 and 16, at the end of there we go. At the end of 15, we got close. We didn't quite get there. You can see the volatility spiked a lot higher. Coming out here to 2011, historical volatility got this high. And you see implied volatility was in the 40s. Remember, volatility right now is at 27. Implied volatility right now is at 27. Implied volatility got there in the 40s. You can see 2010, we never did get there, though implied volatility was higher than it is now at 27. When things really hit the fan, implied volatility was in the mid-30s when historical got this high. And then it just really took off there. Again, we're at 27 right now. And you can see the beginning of 2008, we never got this high. So needless to say, historical volatility is at a rare level, and for it to be this high, and for implied volatility itself to be that low is just, crazy divergence right now, which again kind of suggests that as great as today was, so let's go back to a 1-year chart. As great as today was, we had a 1.87%. We gapped up 0.8%. Coming off of we still haven't really reversed that 4% drop to the upside. I guess today is kind of the beginning of that. We did obviously make a big time move at the end of Friday. So when you count Friday's move, excuse me. If you count Friday's move going into today. So, you get your little calculator out here. You can see we ended up closing at 397 essentially, and we got up, high point was at 397.73. So at the high today, 397.73, we came off of that 380.54 low point late Friday, like kind of middle to late of the day Friday. Darn it, 397.93. divided by 380. You can see that ended up being a 4.5% rally off of that low. So your 4.5, this reversal, that 4% drop occurred midway through the day Friday and into today. It ended up being a 4.5% rally total. So keep in mind that can do that on an intraday basis, not just on a open to close or close to close basis. So again, like I said, make sure you're following me on Twitter at DavidSettle42 is my handle, at DavidSettle42, and you can be able to see more of that kind of stuff there. Let's take a look at some of these other oscillators here really quick. We told you the RSI and CCI, they're not bearish, but they're not bullish either. If you look at the Ichimoku cloud, there's still a very maturely strong trend, though we are above the green line, just barely. We've been there before. This isn't the first time. The Bollinger Bands, remember we talked about, there's a good chance that this Bollinger Band just declines. We're not in the lower quartile anymore. We'll probably stay in the middle. As you see, as the bandwidth declines, you kind of gravitate back toward, in this case, your bandwidth rallied on a bullish move. So when it declined, you came back to the middle. When it declined here, you came back to the middle. When it declined over here, it just kind of stayed bullish, right? Stayed in the upper half. That can happen. But here, when we're down here, you're not going to grind to the downside. You're going to come back to the middle as this falls back down. I expect down to lower levels, to the point where the bands, I think before we get our next leg lower, the bands will, we'll get a red dot, right? The bands will come back inside the Keltner channels, and you can see they probably will tomorrow. They're already the Keltner channels are so wide. The other thing too that we're probably really close to getting is a bullish reversal pattern here. We got a bullish Hakunashi candle today, but you can see the parabolic stars are getting a lot closer than where we were. We're still, way more than 20 days on this current whole decline. You can see that we did get above the moving average of this green line. The green line measures how far away we are from the 200-day hull. So we are pretty deep, and it's going to probably start converging here. And I expect that will happen. I expect we will get above that 23% at 400 and work our way up towards 420, if not kind of in this 410 area first, where there'll be some shorter term, more immediate resistance levels. Let's take a look at today's intraday chart. Higher high, higher low. We did not close above yesterday's high. It was early. Pretty much we did. I mean, that high point was very brief, so we pretty much did close above yesterday's high point there. But it was a higher high, and it was a much, much higher low. And the gap that we haven't really filled in yet, of course, we are above last week's low point, which was Friday's. So we're kind of right smack dab in the middle of the range. Again, expect that we'll kind of be up in here over the next few days, I would expect. If you take a look at today's range, volumes and ranges, 76 million, 7.3 points, again, factor in the gap, 389.63 to 390.838, so about a half a point of a gap, roughly, a little bit more than half. So you're looking at maybe like an 8-point range with a gap, below the average at 10. 76 million is also below the average. In fact, again, when we look down here, 76 million is way down here, so it's really, really low volume. That's not the kind of bullish day that can start a good, strong bullish move. And then the range, again, 8 points is also below. So again, not the type of bullish day. I told you before that it's not very common for historical volatility to be this high. The VIX has never been lower when we've been at this high on the ATR relative to price. It's never been, especially on the ratio chart, never been as low as it is now. So the market's still saying, that it's not sold on the market being sold off. In my opinion, I think it's been a pretty tremendous period of volatility, but not enough of one to capitulate, enough of one to wash out, to say, okay, we are getting a low point here. Now I think we will, get some bullishness, not very strong, but some gradual. I mean, we already today wasn't very strong. So if we get more days like today, it's going to be very gradual, very soft, maybe at the 4,000, like I said, maybe at the 410, and then that's it, right? And you'll probably see, volatility again, not nearly. It's already below 90%. This is amazing for it to be this low. It's at 28. It's below 95%. Will probably come down to 90 by the time this grind higher is done with, before we develop a low point and work our way back up to the upside. So you can see the same kind of levels of support here on the VIX. It's down to the 30-day. Expect it'll probably come down towards the 50 before it kind of finds some support. I don't think we're going to get that kind of drop here. I think it's just going to be more of we're just dropping right now in this area until let's see, let's go back to this chart. Let's go back to a daily. We had this bearish candle, we're reversing it. instead of coming all the way down, I think it'll probably come down to here. And then like we did over here last couple of times, hold support and bounce back up towards, the low 30s, the mid 30s again. Remember, if we were capitulating right now, we'd be at 125%. Like every single other time the markets have capitulated at the end of a correction, right? We've had, the 4 of them since the bear market low point and the correction of, early 2008. So every single time we've capitulated at 125%. So if we were at 125%, right now, the VIX 3M is at 30.29. So 125% of 30.29 is 37.86. So the VIX right now, if we were capitulating, would be at 37.86. Would be right up here right now. Of course, it's not. It's way down to 28. So instead of being 125, it's down to 90, below 95. So that's what we need to see. We won't see it tomorrow. We won't see it this week. We'll hit. I think we'll hit 90% before we'll hit 100. So let's kind of watch to see how we produce this week, what kind of move we produce. Most likely a bullish week for the first time in weeks. And then we'll see what kind of volumes and ranges and how it takes form. If it continues to grind, which I expect it will, smaller moves, smaller ranges, then we'll look for opportunities to be more bearish again once we get towards those resistance levels. What do you think? Do you agree with that? Do you disagree? Let me know in the comment section below, especially if you disagree. Let me know what charts or indicators you're looking at that suggest why you're either a lot more bullish than I am or a lot more bearish than I am. All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That notifies you when our videos are posted. Also, while you're down there, hit that thumbs up icon. That tells us 2 things. 1, you liked the video today. And 2, you want us to do another video again tomorrow. Quick way to let us know you like our stuff and you want us to do it again. If you don't want us to do it again, then don't click on anything. You don't even have to watch if you don't want to. Also, comment down there. What did you get out of our videos today? What stood out to you? What questions do you have about what I brought up, or what comments do you have? Post those in the comment section. Join our website at marketscholars.com. There's a link popping out there on the top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter for more content between the videos from day to day. There's my handle at DavidSettle42. And join our Market Outlook Facebook group that we've created. All right, if you're watching us on our blog here, check out some of these other things on the right. Click on this icon, takes you to our Market Outlook live page. On Monday, Wednesday, and Fridays at 3:30 Eastern Time, I do a live video right here on this page. You can also get to it by clicking on Live Trade Review in our main menu. It's about 10-15 minutes long. I take a look at trades we've done in prior Market Outlook videos, see whether we should stay in them, how we should manage them, whether we should get out of them. We also took a look at today's trade idea already, the one you'll hear at the end of the video, and we already put it on before the market closed. So if that interests you, you can get to that there. Come down here, click on this View More. You can see our upcoming classes. Click on View More. It takes you to our calendar with all of our upcoming classes here for the rest of the month, and then all of our 4 years worth of classes going back. We do 10 of these a week, 10 classes a week here, and they're all recorded, posted, so you can get to those here over on the right. Come down here, click on this heart. It opens up this tab, hit that like button. Same thing here with that thumbs up icon. Click that like button there. Again, the more you do that, it helps us get our content out to more of our followers. That's why we always ask. So we try to make it really easy for you to do it right here while you're watching. Just get in the habit of clicking it while you're already here. It also benefits you because Twitter and Facebook promote content in your timelines from the accounts that you engage with the most. So we try to make it really easy for you to engage with us here. Let's take a look at our asset class chart and see what's driving this price action today. Big down moves in bonds and the dollar. I mean, very outsized down moves. And that obviously the weak dollar propelled gold and commodities to be bullish, though they did not outpace equities. But interestingly enough, again, kind of like this isn't the biggest risk on move because small cap stocks and IWM and large cap, mega cap stocks, QQQ, they didn't outperform SPY, right? And so when you look at this from a sector standpoint to see, okay, well, let's see what sectors outperformed what. We'll come over here to May. And say, okay, well, did XLK, XLY, and XLC outperform? And they didn't really. Financials and energy outperformed. which is interesting because usually IWM does well when those two outperform, and it really didn't. Staples are still pretty bullish. They're coming off a pretty significant low point last week. We'll talk about that with our trade idea at the end of the video. Materials is up there with the weakness in the dollar. Energy materials doing well. Discretionary still not doing so well. Healthcare still not doing so well. Utilities and real estate still doing pretty well. Pretty good return, so not completely risk off. XLI and XLC lagging the market. So not the best returns, not the best market drivers. Let's take a look at some of those moves, especially in TLT. It's a big drop in TLT. It did bring it back down towards its below, its 8-day moving average. This MACD is still positive. The average is still rising down there, right here. Stochastics are still rising. So again, not necessarily, I don't think necessarily we're hitting resistance and rolling over. Let's see if it holds, and this MACD gets back below. That histogram turns back negative. It gets another red arrow again. We get below the moving average, kind of like we did on these others, where we roll over. And remember, the other big move was weakness in the dollar, and the dollar dropping below its 30-day moving average for the first time in a while. Remember, one of the biggest drivers of the dollar strength has been the weakness in the dollar yen, and the dollar yen continues to be relatively weak. In fact, its MACD is at one of its lowest levels all year, which is crazy because this hasn't been very negative. It's been so bullish, but we're so we're not nearly as bullish anymore. It's brought a lot of these oscillators down to relatively low levels. I mentioned too that we still do have the one thing that's very rare to get. It's very rare to get that orange line down below in the lower reversal zone. You see the blue line, which is where are we closing relative to the 4-week range. We're above 32%, so we're back above the orange line. It's a good sign for it to kind of rally back up and see how far up it goes. Again, if you look at like past corrections, like 2018, it never did get below that line. And when it gets above it, it stays above it, right? It makes a pretty decent move towards the 4-week range, and usually makes a pretty decent move on the Arun indicator as well. And so I'm going to be watching that really closely to see when we get a reversal, because usually you'll get the red line to come down below 70, and then you get the spike above, to 100 on the green line. That's kind of the boom, boom. That's the reversal sign. So it takes you can see you get below 70, and then you get the spike right there to a 4-week high. You get below 70, you get the spike up to a pretty decent level. You get below 70 over here, and you get the spike up there. So let's see if we end up getting below 70, if we can continue this and work our way back up to the upside. Let's take a look at how all the major economies, how their sectors are doing outside of Russia, of course. You can see now that there's a lot of green shading and yellow lines. Now, you can see we're barely above moving averages. So this is actually a pretty bearish pattern. We're not getting down the U.S. The U.S. is lagging behind just pretty much everybody else as well, and India is even worse than that. But everybody else is green shading and yellow lines. So there's a pretty good sign of what this will, either we're going to reverse this around and get up to dark green shading, because you're almost to 50, you're at high 30s, mid 40s, or low 40s there. So we're going to continue to turn this around and get dark green shading and eventually a green line, or we're going to we're going to sell off not sell off, but roll over and start selling again as pretty much as quickly as tomorrow or Wednesday. So a good, be a good indication to see just how bearish we are on the U.S. markets, depending upon how these other markets deal with this pretty bearish pattern right now. Like I said, it's one of those signals that obviously you'll get the signal every time you reverse to the upside, but it's also a signal, and you can see we might actually go up a little bit more. Some of these went up a little bit more once they got up above them a while ago, but they can also be immediately bearish. So let's watch and see how this pattern plays out over the next few days. All right, so for our trade idea today, I wanted to take a look at a stock that's really been down a lot last week, and that's Walmart. Walmart dropped at 20% below its 30-day moving average, lowest it's been, multiple clusters, short-term sentiment bouncing, closing above the high of the low day. Obviously a big knife drop here, huge knife drop. You can see why it stopped where it stopped though. If you go over here, you can, let's go to the weekly. In fact, let's go out 20 years to a weekly chart. We stopped right at pretty much right at the 200 week moving average. Big drop in the MACD, about as low as we got back here in early 2018. The MACD's net, it's the only other time the MACD's been this low. If you take a look at the Fibonacci's coming off of that 15 low points, the last time we've had kind of a bear market on Walmart. We didn't even get a bear market at all. We didn't even get a correction in 2018 or COVID on Walmart. We just had kind of deep pullbacks, but we didn't even come close to touching the 200 week. Obviously we did now. So we are in correction mode now, but look, we stopped right at the 38% retracement, right at the 200 week moving average. So there's a reason why we stopped here. And now the issue is there's no volume here. Like we can come right back up to that 23% retracement level, the bottom of the value area. There's no volume above us on that. And all these indicators, I mean, everything you look at, especially like the Bollinger Bands, it's not common to get that far down below the Bollinger Bands. And it usually ends up being kind of rather than a breakout signal that we're going to continue to grind, it's more of a, oh, that's too much of a signal, too much of a break to drop. You can see the same thing too when you're that far below Keltner channels. It's too extreme, right? So, there's how far below the Keltner channel. It's hugely below the Keltner channels. This is too extreme. The bandwidth is extreme. The momentum down here is extreme. Everything is extreme. The trend strength indicators and how deep we are below the cloud, and these lines here is so extreme. Big gaps that we again haven't filled in yet and can easily fill in. Like we still have to fill in that gap there between 130 and 133, and then your gap above this 23. So coming up to 136, 137, it's a pretty decent opportunity. So here's what we decided to do. Let's come over here, take a look at Walmart. We decided, okay, let's do two different bull call spreads. So we will do here, 1 second. We'll do a more aggressive 130, 130, 135, 130 bull call spread. So it's this one right here. Really good reward to risk ratio. Really, about close to 10 to 1. Really, but a very aggressive. It's got to get up there, and you can see where the break even's way up to 130. So to bring that break even down, so you can see if I set my break even here, right there, and I'm going to lock that. To bring that break even down, we did this other one. So this is a lot more conservative. Right? You can see it's a $700 risk for $284 reward. So still pretty aggressive, about a 3 to 1, 2.5 to 1. The max gains easily inside of territory here of the 1 standard deviation, so very easily attainable. Not very easy, but more attainable. So what I did, instead of position sizing for a half a position on each of these individually, I position size a quarter position. So the two combined end up being a half, and two combined end up being that $500. But now my break even, instead of being way up here at 130.5, is down to 127, 128. So now it's going to be, I can start making money a lot faster on this. It doesn't have to go up. So it can go up here between here and 136, 137, depending upon how aggressive it bounces. If it bounces for a really, really low risk, we get a really decent reward, up to almost $3,000. So about almost 6 to 1 reward to risk ratio if it ultimately plays out as we expected it would. All right, well, that wraps us up for today. You've heard from me now. Now I want to hear from you. Use that link that's popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. As always, thank you very much for watching. Remember to subscribe to our YouTube channel. Click that thumbs up icon. Comment on the video. You can also join our website at marketscholars.com. Like us on Twitter and Facebook as well. Have a great rest of your Monday night, everybody, and we'll see you all next time.